Negative amortization could cause a financial crisis that affects everything, including pension funds. And that is what I'm going to take you through in this video, how it will happen and how the financial system is stacked like dominoes right now. So let's get right into this. So how banks are losing money. Let's go through it. So basically on the bank's balance sheet, you've got your mortgage, which they then bundle together with a bunch of other mortgages into something called a mortgage-backed security. So the benefits to the bank are it pays a yield and a dividend. It's priced like a bond. Duration ranges. It's not marked to market. And essentially what that means, if like you have right now, where a lot of the mortgages that were sold in 2020 and 2021, if they went to sell them to another market participant, they would have to mark down those assets a lot because of how much interest rates have gone up. So these mortgage-backed securities, they're not marked to market. So if there's massive potential losses there, they don't have to declare them for earnings. And the reason for that is basically because they plan to hold them to maturity whenever that duration is and whenever that particular mortgage-backed security actually matures. So essentially you have all these mortgages and it gets really interesting because essentially what happens during a default is, guess what? There's no yield / dividend. Bond risk goes up. They're less liquid. Who on earth is going to go and buy a mortgage-backed security essentially that nobody is paying the yield or the dividend on? Nobody wants that. So they become extremely illiquid. Now, this is if they actually had the mortgage-backed securities on their balance sheet. But the fact is, most of what the banks do is they sell them because it's extremely profitable, as I'm going to go through with you now. And most of the people that they're selling those mortgage-backed securities to are pension funds. So let's get into what's gone on and you'll begin to understand this. So what do we know so far about negative amortization? We know it's a systematic problem affecting over 30% of loans in some cases. Right now, the stats are RBC has 25% of loans that are negative amortization, BMO 32%, CIBC 30%. That's of their entire loan portfolio, guys. So if you don't understand how profound that is, you will after this video. So stick with me here because it just gets very, very interesting as it goes on. And this took me a while to make, even though it looks like complete garbage. Losses are hidden currently, and we'll explain that later. So now we're going to go over what happens when a bank sells those mortgages to a pension fund and how it works with even you, the pensioner, if you are on a pension. So basically the bank has the mortgage-backed securities, they sell it to the pension fund, the borrower pays the bank then takes the payment, they pay the pension fund, and they take a 2% fee. You can see how extremely profitable it is. Not only do they get to sell the mortgage bond, they also get to make a fee on the dividend. So essentially they're just remitting payments to the pension fund. Essentially they're just paying the pension fund the dividend and they're taking a 2% fee for doing that. It's extremely profitable for them to do that. And I hope you're beginning to see where the risks start to really come into play. So let's continue on here. So you basically got the pension fund, they pay the pensioner, and they take a 2% fee as well. That's one thing you got to remember about banks, guys. Nobody does anything for nothing. So it's kind of crazy. But now I'm going to go through what happens when obviously there's a default and how it can't be hidden. You know, there are a lot of people that just think the negative amortization can just continue and everything will be fine. But what they don't realize is essentially those borrowers are in default. They're not paying their principal. They're not even paying the interest. So if the bank has then sold all those mortgages to a pension fund, how is it paying the dividend? And that's what we're going to get onto. So anyways, they pay the pension fund. So now we're going to go through what happens when the borrower doesn't pay, which is essentially the scenario right now. And this is what's happening right now, guys. So the bank pays the pension fund, loses the 2% fee. So how are they paying the pension fund? We'll get onto that. So hedging with riskier assets, hiding losses off balance sheet, paying investors with money from and recently sold mortgages, which is essentially a Ponzi scheme. I don't know if you're aware of that. They could be doing that, taking on debt on or off balance sheet. That's also another thing that they could be doing. So it gets really interesting. So what stops them paying? Mortgage sales slow, so they can't do the Ponzi scheme. Other banks don't want to lend because the problem is systematic, meaning it's affecting all banks. So then banks get really cautious about lending during times like that, obviously. Defaults on other loans cause liquidity issues. That could be commercial mortgage-backed securities. So that could be completely unrelated to the problem. It's just got to cause liquidity issues. Financial crisis in the US causes a liquidity crisis in Canada. Quantitative tightening causes liquidity issues because essentially they're losing a lot of their bank reserves now. The central bank is taking them away with quantitative tightening. So liquidity, they're losing liquidity right now. And people forget that quantitative tightening is continuing even though the Bank of Canada has stopped hiking. Nobody wants to buy the mortgages anymore. That's another thing that can happen. And then they're stuck with a bag of garbage, essentially, a bag of flaming garbage. Another thing, obviously an obvious thing, is will QE fix this? QE isn't going to fix mortgage defaults if unemployment is rising, obviously. QE isn't going to fix bank lending sentiment either. QE won't make investors want to buy mortgages. QE won't fix a credit crunch. What QE essentially is it's just more liquidity for the banks via bank reserves to deal with loan losses, and it creates massive moral hazard in the system. It doesn't fix anything. So just because there's QE, don't expect everything to be repaired. This is not 2020 and 2021, and that wasn't the QE that kind of pieced everything back together. That was the massive rampant spending that the government did at the cost of inflation. That's what it really cost us. That was not without its own cost. So we know what will happen if they do that again. And I think they're quite cautious about doing something like that again. Maybe I'm wrong because of inflation, but I guess we'll see as time goes on. So that is what could happen there. So let's move on now. And this is really what's going to come soon with the state of the financial system currently. This is what we're heading to. So the bank can't pay the pension fund, loses the 2% fee, and then the pension fund can't pay the pensioner and they lose the 2% fee. So you can see how everyone's losing the fee, everybody can't pay everyone, and that's essentially a liquidity crisis. And you know, it doesn't have to be caused by this. The banks are experts at hiding losses. They did it before the GFC in the US. I mean, this is just something that they are good at doing. So until the liquidity event happens, and that doesn't have to be anything to do with residential housing, it can be to do with commercial mortgage-backed securities, that is when you will see who is swimming naked, where you will see what is happening in the residential mortgage market in Canada, which is essentially, it's a freaking Ponzi scheme. I think we all know this by now, so it's kind of crazy. And then what's happening in the shadows? Hedging with riskier assets, hiding losses off balance sheet, playing hot potato could be the case. Essentially what I mean there by playing hot potato is everybody's got these mortgage-backed securities and they're just passing around the hot potato like they know it's going to burn their hands. Somebody is going to get caught holding all of this garbage, and it's just a case of how they can move it round and who's going to be caught with their pants down when everything goes south. And when everything went south in 2008, it was Lehman that was caught with their pants down. Well, now it could be somebody like BMO. It could be the Bank of Nova Scotia. We don't know, but we do know that there are going to be massive issues coming in the financial system. And we do know that the banks are losing money despite what their earnings say, despite what they're able to do off balance sheet. We know because we've gone through this and we can see. So if you haven't understood anything I've said here, I would highly recommend you rewatch this video, because I tried to make this as simple as possible for people to understand so that they could understand that negative amortization does have a cost. It's just a case of where is that cost being hidden, and that could cause massive liquidity issues. I mean, if the economy was booming right now, then maybe that could be hidden, right? But the facts are the yield curve is extremely inverted. It's telling us that a massive financial crisis is coming, and this could be that financial crisis, and it could affect everything from pension funds to the entire banking system, because a lot of people buy these mortgages, and these mortgages, a lot of them are also insured by the government through the CMHC, which is backed by the taxpayer. And we all know what's going to happen with that, because essentially the government is not going to foot the bill once is revealed about the fraud in the banking system, the fraud in the mortgage market. Once that comes out, a lot of that risk is going to go back to the banks, and then the CMHC insurance, the CMHC insured mortgage, is basically meaningless, even if it continues on after that. If you enjoyed this video, then you might enjoy that video there. You might enjoy this video here. Don't forget to sign up to my free email list. Link is in the description and the pinned comment. I'll see you in the next one. Take care.